Welcome to Financial Flipside. In today's discussion, let's dive deep into a topic that's been making headlines and sparking debates: inflation. You know, a lot of folks out there are under the impression that the Federal Reserve, often referred to as the Fed, has been quite successful in curbing inflation. After all, they point to the fact that inflation rates dropped from a whopping 9% to a relatively modest 3%. It sounds like a job well done, right? Well, not so fast. Let's unpack this and see why it's not as simple as it seems. First off, that significant drop in inflation rates from 9 to 3% wasn't solely due to the Fed's monetary policies. No, the decline in oil and other commodity prices played a significant role in it. This nosedive in prices came about because of a surge in the value of the US dollar. Currency traders started anticipating that the Fed would raise interest rates, and that made the dollar more attractive, driving its value up. So, the Fed sort of lucked out there, and it's not something they can easily replicate. Fast forward to today, and we're seeing oil prices steadily climb back up, soaring above $81 a barrel. Other commodity prices are following suit, and the dollar, which had its heyday, is now on the decline. So, the headline Consumer Price Index, or CPI, which is a key measure of inflation, has probably hit its low point in the low threes and is now on the rise again. Now, let's talk about the core CPI, something the Fed often emphasizes. While the headline CPI has fluctuated, the core CPI has remained stubbornly high, hovering around 5%. This is concerning because, despite the Fed's efforts to normalize interest rates from near zero to where they are now, it hasn't had a significant impact on core inflation. It's like trying to put out a fire with a garden hose when you need a fire hydrant. And here's a kicker that often goes unnoticed: rate hikes themselves are inflationary. When the Fed raises interest rates, it effectively increases the price of credit and borrowing. So, any business or individual with debt sees their costs rise. This includes landlords with mortgages, businesses that borrowed money for expansion, and anyone with credit card debt. These increased costs of doing business tend to get passed on to consumers in the form of higher prices. So, higher interest rates can actually fuel inflation. Now, let's talk about the Fed's rationale for raising interest rates: to reduce aggregate demand. The idea is to make borrowing more expensive, so people borrow less and spend less. In theory, this would put the brakes on the economy and help combat inflation. But here's the problem: it's not happening. Credit card debt is at an all-time high, and government budget deficits are skyrocketing, even in a non-recessionary environment. So, despite the Fed's efforts to make borrowing more expensive, consumers are still borrowing and spending, driving prices up. So, the big question is, has the Fed actually accomplished anything in its battle against inflation? Well, it's not looking so rosy. And to make matters worse, they've been tweaking the way they calculate the CPI to downplay inflation. It's like changing the rules of the game to make it seem like you're winning. If we measured prices the way we did in the 1970s, a supposed 2% inflation rate would actually be closer to 4%. The Fed has been doing this to justify printing money to stimulate the economy and fund government spending without making tough budgetary decisions. Now, let's shift gears and talk about what the Fed should be doing. Remember the days of Paul Volcker, the former Fed chairman who tackled inflation head-on? He didn't mince words when it came to criticizing deficits and urging Congress to cut spending. Powell, on the other hand, seems to conveniently ignore the massive fiscal stimulus being pursued by the White House and Congress. You see, Powell is trying to put out a fire, which is inflation, but Congress is pouring gasoline on that very fire with its deficit spending spree. It's a classic case of mixed signals and conflicting policies. How can you have stimulative fiscal policies and contractionary monetary policies at the same time? It's like trying to drive with one foot on the gas pedal and the other on the brake. It just won't work. If this deficit spending continues, which it likely will, the Fed will have to choose between letting long-term interest rates skyrocket or resorting to even more aggressive quantitative tightening. Either way, it's going to have dire consequences for the financial sector, real estate, and the overall economy. We're not going back to those super low interest rates of the past, and the path ahead is fraught with challenges. In conclusion, the notion that a minor tweak in interest rates will be the silver bullet to extinguish our inflation woes is overly simplistic. A variety of factors affect inflation, just like the intricate functioning of an ecosystem. The Federal Reserve's traditional tools may not be as effective in this new economic landscape. As we navigate these uncharted waters, we must recognize that the economy is more akin to a multifaceted puzzle than a straightforward equation. The Fed's actions are just one piece of that puzzle, and it's increasingly evident that they alone cannot guarantee victory over inflation. In the grand scheme of things, we're playing a high-stakes game of economic chess. The next moves are pivotal and must be made with the utmost care and consideration. We need a comprehensive strategy that addresses both monetary and fiscal policies, as well as a deeper understanding of the evolving dynamics of inflation. In the midst of this economic uncertainty, one thing is abundantly clear. Our collective ability to adapt and innovate will be paramount. So, when assessing the inflation challenge and the role of the Federal Reserve, it's essential to keep in mind the complexity of the situation. There's no quick fix, and a nuanced, holistic approach is required to successfully tackle the formidable beast that is inflation. The journey ahead is fraught with uncertainty, but with the right strategy and a keen eye on the broader economic landscape, we may yet find a path to stability. We appreciate you taking the time to watch our video. If you liked it, be sure to show your support with a like and share it with your friends and family. To stay on top of financial matters, subscribing and hitting the notification bell is highly recommended. This way, you'll be among the first to know when new content is released.